In the next 30 seconds, I'm going to share everything that I own in my public $113,000 stock portfolio. But before I do that, I've got to say I am not doing this to recommend that anybody copies what I do. These are not recommendations. This is my portfolio. I am sharing how I invest and why I invest that way to hopefully teach other people one aspect and one way that people can invest. So you need to do your own research, talk to a financial advisor. I am not a financial advisor. Let's get started. Here's my portfolio. My largest position is Meta. The cost basis is $26,751. The current value is $26,490. So we'll just jump through those from here and go for the rest. Taiwan Semi is actually up 22%, and that is a $13,000 position. Rocket Lab is down almost 12%, $11,500 position. Shopify is up 16%. $11,100 position. Tesla is down 41%. That is a $9,390 position. Ooh, that one hurts. Snowflake is down 18%. That is a $9,057 position. Datadog is down 31%. That is pretty much $9,000 position. GitLab is down 16% for $6,600. Mercado Libre is up 1%. Brookfield Asset Management, BAM, is up 10% or $477. And then BN, Brookfield Corporation, is up 5%. And those in total are about $10,000. So I wanted to get to my holdings up front because this video is about revealing my portfolio, and that was the first thing I wanted to do. But now I want to talk a little bit about how I'm thinking about investing for 2023, what I think a great strategy for investing is. And the way I'm going to talk about this right now is through sharing and talking about this investor letter, a semi-annual letter from Terry Smith, the CIO of Funsmith. It is, I believe, the largest mutual fund in the UK. Not 100% sure if that is accurate. Okay, and what I'm going to focus on here is that Terry is calling out that he has identified the need for the Fed to raise rates, inflation, the likelihood of a recession coming, and that he thought, that would put pressure on equities. But he didn't sell out and go all cash. And you can see here from January 1st, 2022 to June 30th, he was down 17.8% versus his index, which is actually the MSCI World Index. That's what he compares this fund to, was down 11.3%. But since inception, which for them, they started in 2010, he's up 15.8% per year versus 11% from the index that they benchmark themselves to. And so even though he's down more than the market last year, and he ended the year down more than the market as well, he was still beating the market long term, right? Okay, so I'm not going to cover this whole thing, but right here he's saying that there's a chance that if a recession ensues but inflation persists, we will not have seen conditions of this sort since the 1970s when the term stagflation was coined. And that was his first full year of work, was in 74. Inflation got up to 24%. And basically what he's saying happened, and this was a Bank of England Governor Lord King of Lothbury who I think observed this. This was back in, sometime in June-ish that he said this. What they think happened is that attempts were made to stimulate demand further by further quantitative easing when the issue was not weak demand, but a lack of supply due to everything being shut down. And so now we have found ourselves down this road where we've got to raise rates to, control spending, do quantitative tightening and everything. You know what's going on with the Fed by this point, most likely. So they're saying raising rates is now a necessity that will eventually quell demand, but it may take a while to become effective because consumers were quite liquid given the lack of certain types of spending opportunities in the pandemic. Higher interest rates will do nothing to correct the continuing supply problems in commodities, semiconductors, just about everything else. So may also take some time and high interest rates for demand to become depressed enough for the supply to exceed it and start to moderate price inflation. Remember, he said this back in July in his letter, right? But the reason I'm pointing all this out is because even though he felt this way, he comes down here to say we do not invest on the basis of our prognostications about macroeconomics, but it is not a matter of speculation that we now have inflation. Inflation, rising interest rates, and an increasingly likely recession have two obvious effects on equity investments: fundamental effects and valuation effects. He's going to address both right here, and this is kind of the last part I'll cover, but basically fundamentals, things get more expensive for companies, right? That makes the cost of goods sold and the cost of doing business more expensive for companies. That makes them less profitable. So one of the things he looks for is companies with high gross margins. That is something I look for as well in my investments, and something I think investors should do in any environment, but especially in a environment with high inflation, rates rising, and things like that. But anyways, he said the difference between sales revenues and cost of goods sold on average last year for the companies in the portfolio, his portfolio had a gross margin of 60%, compared with about 40% for the average large listed company. So our companies make things for $4 and sell them for $10 or pounds, whereas the average company makes things for £6 and sells them for 10. A 10% rise in the cost of goods sold clearly has much less effect on the profitability of companies in our portfolio than the average company, because his portfolio companies have higher gross margins. If they want to compensate for a 10% rise in cost of goods sold, their portfolio companies can achieve this with a much smaller price rise, so talking about pricing power, than the average company. The effect on cost of goods sold is not only the effect on inflation, but it is clear that the high and sustainable gross profit margins of our companies provide a robust first line of defense. And here he talks about actually why he doesn't want to own Target and will never own Target. Again, Target retailer, a stock we would never own. Gross margin contracted from 30% to 25% in the same quarter year over year, which was a fall of 4.3 percentage points, driven largely by inventory impairments, lower than expected sales, things like that. But that meant that their operating margin fell from 9.8% in the prior year quarter to 5.3%. And this is where it really starts to matter. So by a similar 4.5 percentage points, their operating profit declined 43%. The combination of low gross margin and high fixed costs is dangerous, and they seek to avoid it. This is why I focus on high gross margin companies. And he goes on to say in this letter that, he wasn't thinking about rotating into energy. He wasn't thinking about rotating into airlines because of the reopening, because those industries are industries he does not want to be invested in because of their margin characteristics. They are low margin businesses. And so even though he pretty much knew it was going to hurt his returns and there was going to be some type of rotation, he didn't go into those sectors. And that, I think that speaks to a lot of the style investor I want to be and the style of investor that I think is successful over the long term. One that has a process. Maybe you are only invested in energy. Well, then that should be your process, Anyways, one that has a process and sticks with that, and it's one that they are aware of how it works in different economic cycles, and then is able to stick through that through good and bad markets. Okay, and he does say that long-dated assets will fare worse than short-dated ones. So equities, stocks, are actually a form of long-dated assets. This applies not only to bonds, but also to equities. Share prices of more highly rated companies, which are in effect discounting. This is what happens if you have a higher PE ratio or a higher price sales ratio. That means you are discounting profits or cash flows further into the future by being rated on higher PEs. Those tend to be more affected by rising interest rates than lowly so-called value stocks. We saw that exact thing happen. He says our portfolio is not exempt from this effect. Broadly speaking, the stocks that have suffered the most from rising interest rates so far were those that started the year the most highly rated and were thus most impacted by the discounting rate or the rising discount rate. He talks about the 5 biggest detractors. Okay, but this is the important point. This is what I really want to hammer home as to why they don't seek those bargain industries or try to rotate. Did we miss out by not owning much more lowly rated value stocks during this period? Not much. The much talked about rotation from growth to value stocks during the first half of 2022 was rather underwhelming from the perspective of the latter. In the US, the S&P Value Index did indeed significantly outperform the S&P growth counterpart and the NASDAQ, but this outperformance took the form of a 12% fall for the S&P Value Index versus a 28% decline for the S&P Growth Index and a 30% decline for the NASDAQ. Falling less than others when times are tough has obvious merit, but still isn't a sufficient payback for the long preceding wait during which value stocks underperformed massively. And here is what he's talking about. In the US, the S&P Energy Index increased 29% in the first half, while in the UK, BP shares rose 17% and Shell 34%. For those regretting the absence of energy stocks from our portfolio, this is key. These increases have only taken the energy index back to levels it first reached in 2008, or the two UK stocks reached in the 1990s. So what he's saying is that the crazy outperformance of these energy stocks, they are now finally back to where they were in either 2008 or the 1990s. If you look at any big, successful tech stock, I mean, it is just pretty much miles ahead of where it was in 2008 or back in the 90s. You look at Microsoft, you look at Amazon. I mean, any of them are miles ahead. Unless now, where people really got hurt is owning crazy spec stocks that are just way too overvalued and have no path to profitability. My portfolio has been crushed by that. I don't think I own crazy spec stocks, but I own a lot of cloud stocks that are pretty far from profitability. What I think is that they'll grow fast enough for long enough and become profitable to where these investments will still work out. I'm going to track it over time, so subscribe to the channel if you like that. But this is how he tries to avoid, getting into companies that he doesn't want to own, even though he likes, growth-oriented companies. He tries to avoid, meme and momentum type stocks, and this is what he looks for. Just go to funsmith.co.uk if you want to read this stuff for yourself. But the company will invest in equities on a global basis. The approach is to be a long-term investor in its chosen stocks, will not adopt short-term trading strategies. And basically, this is what they look for. They want to own high-quality businesses that can sustain a high return on operating capital employed, businesses whose advantages are difficult to replicate, businesses which do not require significant leverage to generate returns, businesses with a high degree of certainty of growth from reinvestment of their cash flows at high rates of return, businesses that are resilient to change, particularly technological innovation, and businesses whose valuation is considered by the company to be attractive. Now, this is where I messed up. A lot of people have messed up, is I owned, clearly just way too overvalued stocks. That's something I'm working on and something I'm trying to improve as an investor. I was going to go through each of the companies in my portfolio and talk about, my thesis, and then share some of the metrics and why they have high gross margins, their free cash flow margins, what I think their competitive advantage is. This video is getting a little long, and so what I'm going to do is I'm going to break it into another video. If you want to see that video, subscribe to the channel and you'll make sure you get it, and do me a favor and like this video too, because it'll help more people find it if it was helpful and you enjoyed it. And if you want to, I cover all of this stuff weekly on a regular basis in my investing newsletter that's free, that you can subscribe to. It's down in the description below. So just click on that link, austin.substack.com. In the comments, it'll take you to my newsletter. And there you can get it via email. You can get charts and different things in your email that you can save and reference and not just have a YouTube video. So anyways, if you want to support me, those are the ways you can do it completely for free. Thank you for watching. If you're a long-term investor, my goal with this channel is transparency and education. If that's helpful and you enjoy the ride, throw a thumbs up, subscribe to the channel. It really helps me out. Hope you have a great day. Let me know in the comments if there's any stocks you want me to cover as well. Thanks.